a new high.
Hasbro says they're going to have to increase their prices. Goldman Sachs says 86% of the tariff revenue collected so far has been paid by American businesses and consumers. So just bottom line, Mr. Secretary, do you acknowledge that these tariffs are a tax on American consumers?
No, I don't.
Even though you have companies saying they are going to have to increase prices, and given the fact that 86% of these tariffs so far have been paid by Americans.
You're quoting Goldman Sachs. So
yes, Goldman Sachs, correct.
I said, yeah. I made a good career trading against Goldman Sachs.
Okay, all right. I do want to talk.
Several days later.
This is what prices that wholesalers pay to get their goods for August unexpectedly fell negative 0.1% for the month of August, month over month. And at the core level, stripping out volatile food and energy prices, also surprisingly fell 0.1%. The expectation for both of those was 0.3. Year over year, PPI coming in at 2.6%. 2.6%, major drop from 3.3%, which was the expectation. Also the same number as July. That was the highest since February. That goes down to 2.6%.
That's a real shocker, Steve. The idea that inflation is so much weaker than anticipated.
Boy, oh boy, oh boy, oh boy, oh boy. So on this episode of the mainstream liberal media, coping over the fact that once again, it seems as if President Trump was right, specifically on economic policy, or the effects of his economic policy, that is. We got to talk about the latest shock inflation report, the PPI report, the Producer Price Index, which basically measures wholesale prices, right? What do businesses pay for goods and services, okay? And this report essentially showed that we're not seeing the hyperinflation that the mainstream liberal media and the woke economists predicted at the beginning of President Trump's tariff policy, okay? We're just not seeing it, okay? And again, they're coping with the reality that the inflation that they predicted just has not happened yet, at least according to the government numbers, which may or may not be accurate. Who knows at this point? But regardless, as of right now, again, these people have been wrong.
PPI, wholesale inflation for August, expected to be up 0.3. No. Down 0.1%. Down 0.1. Wow. That would be the first negative number since April of this year when it was minus 0.2. If you strip out food and energy, we're also expecting up 0.3. It's minus 0.1 as well. Minus 0.1, the same. Last time we had a minus number was April, and we're comping to minus 0.2 in April. And I do want to point out, last month we had up 0.9 on both those variables. They were the highest going back to March of 22. They just were revised slightly lower to 0.7, so 0.7% for each of those in the rearview mirror for July. Now let's look at ex-food, energy, and trade. Finally, as expected, up 0.3, which follows up 0.6, unrevised at this point. Up 0.3 would actually be the smallest, going back to 0 in June of this year. Now the year over year, in my opinion, these are the most important. And boy, I'm surprised. Real progress here. 2.6 on year over year headline. We are expecting 3.3 in the rearview mirror, 3.3. 2.6 will be the lowest since it was 2.4 in June, and it underscores whether it was tariff driven or not. Those little blips seem to be moving back into the sunset.
The latest Producer Price Index shows wholesale inflation cooled slightly last month. Let's get the very latest from CNN's Matt Egan. Okay, we just had producer prices come in. That's the breaking news. Tell us what the numbers say.
Yeah, John, look, this is an inflation report that is coming in cool, and that is a big relief after a red-hot reading the month before. So producer prices unexpectedly falling by 0.1% between July and August. Now remember, this is wholesale inflation before it gets to all of us at the checkout aisle. The annual inflation rate for producer prices cooling to 2.6%. That is better than expected. And again, that is a notable improvement from the month before. Now here's the thing though. Why did this happen? One of the reasons why we're now seeing this big decline in prices, this unexpected decline in prices after the spike in July, is because there was a drop in what's known as trade services. This essentially measures the margins that businesses have. And so what it shows is that some companies are absorbing the cost of higher prices, some of which are being driven by tariffs. The problem, though, economists say, is when you see that happen, that often is a signal that they're going to pass along at least some of those costs to all of us as consumers. So that's something to keep an eye on. But when you look at the annual rate for producer prices, it does remain elevated, dipping a little bit right here, okay, but still above that 2% that would be considered healthy. Obviously, way better than 3 years ago when you had about 11% for wholesale inflation. That was a nightmare. But also, it's really not back to target, and it has ticked a little bit higher. John, all of this coming ahead of tomorrow's more important consumer price index, and that is going to be something that's going to be watched very closely by investors and economists, and of course, the Federal Reserve. You take a quick look, U.S. stock futures, not a major reaction here. I would note that any gain today would be a record high for the Dow, the S&P, or the NASDAQ.
Yeah. So like I told you guys, this is a Trump was right once again moment. Okay. What we discovered yesterday. Okay. We talked about the bombshell labor report that came out that basically showed that almost 1 million jobs that we thought were created during the Biden administration, during the last year of the Biden administration, didn't actually exist, which means that Trump inherited a weak economy, right? So this narrative from the mainstream liberal media that, Trump inherited such a strong economy from Biden and tariffs ruined it. Not true, right? The labor market was struggling coming into, okay, President Trump going into office, right? So, again, not only did Trump inherit a weak economy, right? Biden's economy was fake, okay? But also on top of that, you have inflation reports, again, suggesting that we're not seeing the hyperinflation, the surge in inflation like the economists predicted, which would justify rate cuts, okay? And that's why you're seeing the markets, for the most part, generally speaking, as of the making of this video, they're surging, okay? Because now it seems almost certain that we're going to get rate cuts due to the fact that we have a weak labor market that President Trump inherited, okay, from Biden, right? Let's be clear, okay? We're still in the residuals of the Biden economy, okay? That's what we're experiencing right now, okay? There has not been enough time for President Trump's policies to really start to take effect and for people to really see what the Trump economy is going to look like, right? Let's be real. We're still experiencing the residuals of the Biden economy. So, again, he inherited a weak labor market. Tariffs are not contributing significantly to inflation. And you're seeing inflation, again, not surging the way that the economists predicted, which, again, would justify rate cuts, okay? And now the economists are coming out here and they're admitting that, yeah, Trump was kind of right on this stuff. And we're just simply not seeing what the mainstream liberal media predicted. So without further ado, let's get into it.
Potential third option, as Steve was talking about these two options, is it the buyers that are doing it? It is the sellers who are paying for it. There's a subsection, a third category that could come up part of this, and maybe it ties back to the fact that the jobs market is so weak. Are the makers of this stuff eating it but making up for it by squeezing as much productivity out of as they can out of their existing job base, not hiring new people, and maybe relying a little on AI to get some of that effectiveness kind of wrung out of things?
And you're absolutely right. There's the exporter, there's the importer, and there's the consumer. And so far, the consumer is carrying the least of the burden. I can tell you what's going on right now in companies is they're going product by product, going through the elasticities, what they think the consumer can absorb in terms of price increase without destroying demand. And they're finding out that they cannot pass through as much of the price increase as they want.
Bam. The reason why I'm laughing is because what I'm hearing, right, in plain English, is an economist, okay, PhD, okay, discovering the law of supply and demand, right, which is that you cannot have arbitrary price increases. That's just not how it works because firms don't set prices outside of monopoly situations, right? The market, right, supply and demand sets price, and companies are going to charge, right? And they're going to produce at the profit maximizing price. Okay. That's what they're going to do. Okay. So what this guy is saying in plain English is that companies are looking at the elasticities of demand for products, and the products that are more elastic in demand, which basically means that when you increase or decrease the price of a good or service, the demand changes significantly as a result, right? Which means that if you all of a sudden try to push 100% of the tariff costs onto customers in a market for a good that has elastic demand, okay, or more elastic demand, what happens is that consumers just stop buying it, which means that the company's going to make less money because they're not selling as much. So again, that's how it works. Companies can't just arbitrarily set prices. This is why I never bought into the left-wing narrative that all of these companies, especially grocery stores, they're price gouging, right? And it's like, that's just peak ignorance, because that's not how it works. You can't price gouge outside of a monopoly situation, okay? So again, these accusations of price gouging, again, was just ridiculous to me because they just ignored, again, supply and demand, okay? So again, what he's saying in plain English, and this is something I've explained when talking about tariffs, why I never bought into this narrative that tariffs were so inflationary and that consumers would foot the bill on tariffs completely, is because that's not how it works, okay? You cannot just arbitrarily increase prices in any market, especially in markets that have a very elastic demand curve. Like, for example, all that cheap Chinese junk, right, that we get, okay, that people like to buy off Amazon and stuff like that. Yeah, there are a lot of substitutes, okay, for that cheap Chinese junk, okay? It's not needed, right? It is more of a luxury purchase, right? It's not a necessity that people depend on. If you increase prices too much, people are just going to stop buying it, right? They're not going to buy it because they can live without it, right? Again, the demand curve is very elastic. So thinking that the price of those goods was just going to skyrocket is ridiculous, because the market, the demand for those goods at a certain price is not there, which means that companies, they're not going to be able to make money, right? They're not going to turn a profit, okay, if they charge too much, right? Now, again, they're admitting that, hey, these tariffs aren't being passed on to consumers like we thought, which again is why we're not seeing the massive inflation that they predicted. Okay. However, that doesn't mean that there is no trade-offs, right? And this is where these people got it wrong in regards to their criticism of Trump's policies. I think there are valid criticisms of Trump's tariffs, and this is why I'm not a protectionist, right? I'm for fair trade, okay, in the strategic use of tariffs, because again, there are trade-offs. It's not a good thing for businesses to be absorbing the cost of tariffs, because what happens is that they can't pass it on to consumers. They're going to have to try to make up for it in other places. They make up for it by cutting jobs. They make up for it by reducing production, research, investment, things of that nature, right? Again, especially companies that rely heavily on imports, right? Inputs from overseas in order to make products, okay, or to provide services. So that's not necessarily a good thing. Now, you know, these businesses, all of them, they aren't completely absorbing the tariffs. The foreign company producing the input, they're also absorbing the tariffs because they're being forced to lower their prices. Because just like consumers, okay, me and you have a demand curve for certain products and services, so do producers, right? Or so do businesses. When they go overseas and they buy products and services from foreign producers, there's a certain price that they're not going to buy, which could force foreign producers to lower their prices in order to compensate for the tariff. So my point, again, from an economic standpoint, is that tariffs cause inefficiencies. And where these people got it wrong is that they try to go after Trump when it comes to inflation, but the Fed already studied the effect of tariffs on inflation, and it is a rounding error because imports are just not that important for our economy. We have a service-based economy, okay? So the Fed knew, they all knew that tariffs weren't really inflationary, right? They knew that. But again, because they believe that the American public is dumb, right? They pushed this narrative that the tariffs was going to cause massive inflation, and it's just not showing up in the data. And this is why they continue to say, well, next month, right? Next month it's gonna happen. It's like the Fed studied this. They said that the price increases as a result of tariffs were immediate, right? Now all of a sudden they're saying, well, we gotta wait and see, which again shows you that they're not data dependent, right? That all of these decisions that are being made are political, not data dependent, right? Because again, they should have known. Nobody should be surprised that the great inflation didn't happen as a result of the tariffs. Now, the inflation that we do have, which again is essentially where the historical average is at this point, right? If you believe the government numbers, between 2 to 3%. Again, it being over 2% is probably a result of the fact that our deficit to GDP ratio is a lot higher than it was before the pandemic, okay? And this is why I have questions about whether or not the 2% CPI goal actually really makes sense in the context of this economy, because it's not the same economy that it was before the pandemic, right? And I think that the economists are realizing that they're looking at this the wrong way, right? And that their Trump derangement has clouded their judgment.
And that is particularly true for those who sell to lower income consumers. So what we're getting is this has to be absorbed either by the exporter or the importer. They get hit on the profit margin. The consumer, because the consumer is
Well, we've passed it on to consumers for 5 years now, ever since COVID hit. Remember, Carlos Gutierrez came on and said, look, if prices are going up as a manufacturer, as a company, you better get ahead of it and raise the cost to consumers. Consumers are saying, no more. We can't take it.
Correct. Consumers at the time had checks appearing in the mail.
Yeah.
So they were able to absorb the price shock. They cannot absorb the price shock right now. So what we're learning...
Yeah, because that was demand-side stimulus, right? And again, there's a difference between demand-side stimulus and supply-side stimulus. Demand-side stimulus is more inflationary than supply-side stimulus because supply-side stimulus puts money in the hands of businesses who are going to be more efficient and smarter with their money, generally speaking, right? They're going to put their money into projects that actually produce stuff, right? Rather than putting money in the hands of consumers who just buy stuff, right? So again, there are two different things. That demand side stimulus definitely drove inflation, and companies could increase prices because the demand was there. The money was in the pockets of consumers, and that supported the price increase. We don't have that right now, right? Which again is why you're not seeing the inflation that these people predicted. Now, again, we don't know what the Trump administration is going to do with that tariff money. There's been talk about them using the tariff money to give out stimulus checks to people. I don't think that's a good idea. And the reason why I don't think it's a good idea is because that could actually lead to some inflation, right? That might actually make people okay with paying higher prices, which again, would cause inflation. If they're going to do something with the money, they probably should try to pay down the debt, right? Or to reduce the deficit. Or they should probably subsidize the farm industry that is being hit particularly hard by the tariffs, and they're probably gonna have to do that anyways, right? And that's probably what you're gonna see, depending on what happens with this current Supreme Court case that's coming up involving the tariffs and whether or not Trump can actually do this. So again, there's a lot of stuff that remains unresolved, but the worst thing that the Trump administration could do is to start handing out that money to consumers, right, to people, because again, that in and of itself may be inflationary.
Is that the final impact on the consumer is much less than people expected. This number now, if the Fed is truly data dependent, the question should be, why not 50?
Right. Do you think that's on the table in a big way at this point?
If it's a data dependent Fed, it should be. The employment side is much weaker than they expected, much weaker. And now the latest inflation print is much better than they...
Okay, but if you're right, then should equities be moving higher on the back of this news? And is that solely a function of the Fed? And does that even make sense at this point in the ballgame?
The economy is not great.
Right. No, that's why what's happening now is the market's doing this sort of bad news is good news situation. But I'm wondering whether there's going to be bad news is bad news.
Okay. So look what's happening. When you look at the risk-on assets, equities, credit spreads, they are near or at record level. If you look at the risk-off assets, gold, record level. If you look at government bonds, they're now finally out of they're now in bull market territory since the lows of 2022. So we have this situation where risk on and risk off are rewarding investors. Okay, so don't just focus on the risk on. Also ask the question, why is the risk off also doing so well?
But then
Well, I can speak to that. Okay, I'm not going to speak to the bond market, but I will speak on gold. Okay, and why we're seeing a surge in what he characterizes as a risk-off asset is because there are a multitude of macroeconomic factors and geopolitics that plays into, again, why we're seeing the surge in gold. Gold, historically speaking, has been seen as a safe haven asset, as a hedge against inflation, as a hedge against money printing. Now, gold is probably going to continue to skyrocket, at least probably for the next year or so, because of the fact that if interest rates are lowered, that could bring on more inflation. And we also know that the Fed next year probably is going to go back into a cycle of quantitative easing, okay? So they're going to start buying bonds on the open market. They're going to start putting more money into the economy. That could be inflationary. We're going to see, but essentially it's a hedge against money printing, okay? People are buying into gold because they realize that the government's not going to stop spending no matter what, right? It doesn't matter Republican or Democrat. They're not going to stop spending, right? So at some point, right, who knows what could happen to the dollar as a result. And that's why people are piling into gold. But also, there are foreign countries, like, for example, Russia, China, who are hedging against the U.S. and our weaponization of the dollar to sanction countries that don't want to play ball. So they're hedging against debasement, which, again, is money printing, right, and the sanctions that the U.S. likes to hand out on countries that don't want to play ball, right? Weaponizing the dollar in order to get countries to play ball. So yeah, I mean, that's what you're saying, right? That's why you're seeing gold skyrocket. And I said this at the beginning of the year, and I've been saying it throughout the year, right? That, hey, with the way things are looking, okay, assets are going to do well, okay? Gold is up 37.92% year to date. Okay, I've been talking about gold. Okay, I've been talking about Bitcoin, which is a risk-on asset that I think in the long term will perform like gold, because I believe that Bitcoin is a store of value just like gold, up 21.15%. Something else I talked about as well, too, at the beginning of the year, AI, right? The Mag 7 up 13.09% year to date. Semiconductors, okay, up 26.51%. Again, these are things that I've talked about, right, at the beginning of the year, is that when you look at the policies of the Trump administration, the asset classes that are going to do well, gold, Bitcoin, semiconductors, AI. I said this at the beginning of the year. Gold, Bitcoin, semiconductors, AI, okay? And what we're seeing here is that they're doing very well. Now, again, with interest rates probably going to come down, we're going to see what happens with the CPI report tomorrow. If that comes in under 3%, yeah, we're going to see a huge surge. There's $7 trillion plus sitting in money markets, sitting on the sidelines, right? And if interest rates decline, then you're going to see people start to invest that money, okay, because they're not going to have their money sitting in a money market collecting dirt, okay, if interest rates decide to decline. And I think that's where you're really going to see a boom, not just in the asset market, okay, but I think that you're going to see more economic activity, and I think that you're going to see things really start to turn around, right? I think you're going to see a productivity boom over the next year, because there will be enough time for these companies to take advantage of the policies of the Trump administration, okay, and lower interest rates, which, again, will lower the cost of borrowing, okay, lower the cost of capital. And that's why I say a year from now is when you can really judge. Or, I mean, probably a year and a half, maybe 2 years. But at the very least, people should wait a year, right? This is why I'm not panicking. I'm not worried about, how people feel about the economy right now, because I know there just hasn't been enough time, okay, for President Trump's policies to actually really start to work. And, again, we're going to start to see interest rates come down here, okay? And as long as it's not inflationary, right? If we don't see much inflation and we see more productivity, then we can really start to see the fruits of President Trump's economic policies. But again, it just hasn't been enough time. And we got to see what happens. We got to take a wait and see approach to these things. And I think that that is the mistake that the mainstream liberal media made when it came to President Trump and his tariffs, is that they didn't take a wait and see approach. And this is why they have egg on their face when it comes to a lot of their predictions being wrong. So let me know what you guys think. Make sure you like, comment, and subscribe. Most importantly, share a Black conservative perspective. Peace.